In this video, I'm going to break down exactly how many shares of the SPY ETF you would need to retire in either 2030 or 2040. Let's be honest here. Nobody wants to be working until they're 65 or 70 years old. Or at least if you are still working, you probably want it to be on something that you enjoy. But in order to have the freedom and flexibility to do that, to escape the cold in the wintertime and get somewhere warm, to travel around the world, to take a risk and start a business and not have to worry about money, to wake up every day and go to bed at night, and in between, do whatever makes you feel happy and fulfilled. In order to have that type of freedom, you need to achieve financial independence. Now, there's a lot of different ways to make enough money by investing to retire, but some of them are definitely riskier than others. Going all in on one single stock could make you a ton of money, or if you choose poorly, you could lose it all. But index fund or ETF investing is one of the safest and most reliable ways to get a solid return on investment over time. And the SPY ETF, which tracks the US S&P 500 market, is one of the most well-known and well-established exchange-traded funds out there. So let's dig in and find out exactly how many shares of SPY you would need to retire in either 2030 or 2040. Before we can figure out how many shares of SPY we need to retire, we first need to have a good idea of how much money we're going to need in retirement, and then we can work backwards from there. So I've created this spreadsheet to show you all the math that goes into this, and I'll leave a link in the description box in case you want to take a look. Let me know what you think about my assumptions here, and also you can even make a copy of it and then adjust it to your own personal circumstances to see how it would fit with your life. Anyways, today the average household expenses for a consumer unit of 2.5 people on average is $5,000 per month. However, since we're not looking to retire today, but in 2030, we have to account for the inflation that's going to occur over the next 8 years or so. And if we assume a 4% per year inflation between now and 2030, which is actually much higher than the norm, but as we've seen over the past few quarters, inflation has definitely increased, the average monthly expenses for the same size household would be around $6,800. And on an annual basis, that's $81,600 per year. Now, the average length of retirement in the US is only 18 years, but let's assume that we're going to be retired for 25 years because, of course, we want to retire a little bit earlier and then enjoy some of the nicer parts of life. So if we assume that we're spending 25 years in retirement and spending $81,600 per year in 2030 dollars, that means we're going to be spending just over $2 million over the course of that 25-year period. But we don't have to have $2 million invested on the day that we retire because, of course, all the money that we've accumulated continues to earn interest and to snowball while we're retired, and then we slowly draw down on that. Now, bear with me here because we're almost through this part, but we're also going to have to factor in at what rate is our investment going to continue to grow in perpetuity after we've retired. Now, the inflation-adjusted average S&P 500 ROI is around 8.29% per year, and the annual fee for the ETF is 0.095. So if we assume that there's a slight bump in long-term inflation post 2030, then I think we could pencil in 8% per year perpetual growth. And it's important to remember that this is inflation adjusted, so the actual growth rate will be higher, but I'm doing it like this just so that we can see what the values would be in 2030 dollars. Otherwise, it gets a little bit too complicated to conceptualize. So in simple terms, that means that we have to have $900,000 invested in the SPY ETF by 2030. And to help visualize it, let's look at this simple retirement calculator. If you start with $900,000 by 2030 and you assume that you're going to be taking out $6,800 per month for 25 years with that 8% per year perpetual growth, then you can see how the balance of your principal goes down over time in retirement. And remember, this is adjusted for inflation. It's just presented in 2030 dollars. And by the end of it, you would even have $100,000 left. So $900,000 is the 2030 goal. But what if we push our retirement out to 2040? What does the situation look like then? Well, there's a few differences. So we have to factor in inflation between today and 2040. And if we assume a 3% per year inflation over the next 18 years or so, then the average monthly expenses would probably be around $8,500, meaning that you'd be spending around $100,000 per year. And so the costs to spend 25 years in retirement would be over $2.5 million instead of $2 million in the 2030 situation. And if we take the same perpetual growth rate, that means that we need to have $1.12 million invested by 2040. Again, you can visualize it by using a simple retirement calculator and see how that would work. So So this is where the fun part of the calculation starts. So in order to figure out how many shares we would need, we need to figure out approximately what the growth rate of the SPY ETF will be between now and when we're trying to retire, in 2030 or 2040. I've laid out 3 different possible scenarios for the growth rate in the SPY ETF over the next 8 or 18 years. There's a low scenario at 6% growth, a medium at 9%, and a high at 12%. And the reason why it's important to check a couple of different scenarios is because the market conditions over the next few years could be different from the historical average. So let's go through these and see how many shares of SPY it would take to retire in each scenario by 2030. So the market cap of SPY as of the time of this recording is around $420 billion. And I've got this third tab here where I lay out all of the math for each scenario, as well as account for the number of shares outstanding increasing at an average issuance rate of around 2% per year. So if we go back here to the low growth scenario, if there's only 6% growth per year between now and 2030, then the market cap of the ETF would be around $670 billion by 2030. With a share price of $600, that means we would need 1,500 shares to retire. And at today's prices, that costs slightly less than $660,000. In the middle scenario, if there's an average of 9% growth per year between now and 2030, then the market cap of the ETF would be $836 billion. With a share price of $750, we would only need 1,200 shares to retire. And in the high scenario, if there was 12% per year growth for the next 8 years or so, that means that the market cap would be just over $1 trillion, a share price of 930, and we would need 967 shares to be able to retire. At today's prices, that many shares would cost $423,000. Now, I know these numbers might seem daunting or potentially unattainable, but this is because we've projected for retirement in 2030, which is only 8 years away. But if we look at the 2040 scenario, which is 18 years away, you will see just how much better and how much easier it is to retire when you start investing earlier, because you have that snowball effect over a much longer period of time. So by 2040, our target was to have $1.12 million invested. And with the same assumptions and the same projected growth rates, in the low scenario, that means that we would need to have 1,273 shares. In the middle scenario, we would need to have 770 shares, and in the high scenario, we would only need 472 shares. So as you can see, it's not only the return on investment that matters, but also how early you start, because the earlier the better, and you'll need less upfront capital to be able to retire, because more of what you need to cover your expenses in retirement will be covered by those capital gains that you see, the appreciation of the value of your investments over time. So there you go. If you're thinking about retiring in 2030 and you want to do it exclusively off of index funds, I hope you've already started, and I hope you have some capital that's already been built up. However, if your retirement date is until 2040 or even potentially later, you can see the power of compound interest through these calculations. And just remember, the sooner that you get started, the better. Thanks so much for watching. If you enjoyed this video, you might also like this one or this one. Have yourself a great day, and I'll see you later.